Welcome to the Broken Pie Chart Podcast, episode number 2. I'm your host, Derek Moore, and today we'll be talking about the yield curve, or rather the inversion of the yield curve, and all things to do with that. If you've been following the news lately and watching CNBC or the other various networks, reading things online, you're probably seeing a plethora of stories talking about how the yield curve is flattening, how there's a potential of it being inverted, how the inversions in the past have led to or preceded most of the recessions, and how it's potentially bad for the market. And then you're going to hear the other side about how, quote unquote, this time is different. And it might not matter, and how we're in a new paradigm, and the Federal Reserve has kept rates low for so long that we're in a different era. So let's sort of unpack some of that. And at the end, I'll give you my thoughts on, any of this stuff that is causing you worry. Maybe it doesn't matter as long as you've got sort of some protection in place on your investments and portfolio. So without further ado, let's just get into it. So when you're hearing about the yield curve, okay, what they're referring to is what various maturities of U.S. Treasuries are paying. And so to give you kind of an example, if you were to pull up a quote machine or Bloomberg or CNBC or CNN Money, any of those, and you looked at what the current interest rates were for U.S. Treasury bonds. And of course, U.S. Treasury bonds are bonds that are issued by the U.S. government. They are, quote unquote, backed by the full faith and credit of the United States Treasury. And they have maturities anywhere, really from 3 months that you sort of follow, 3 months all the way to 30 years. And so you'll see, 3 months, 6 month, 1 year, 2 years, 5, 10, and 30 years. Now, maybe we'll do another episode at some point about the effective interest rates on fixed income, i.e. bonds, but for now, just know that the shorter end of maturities have less sensitivity to interest rates, and the further out, they have more sensitivity to changes in interest rates. And so when we talk about the yield curve, if you were to start on the left-hand side and say, okay, the 3-month Treasury is yielding this much percent, and then you went to the 6-month, the 1 year, the 2 year, 5 year, all the way out to 30s, and you would just write in and plot what the interest rate was, that would form a line. And typically that line is going to go from the lower left-hand corner, where shorter term maturities are yielding less in interest than longer dated maturities. And so you would expect the 30-year Treasury bond to be paying a higher amount of interest than you would, let's say, the 3-month bond. And so when you're talking about a yield curve, you're essentially talking about just plotting and drawing a line across the various maturities. And if you were looking at a chart, you might have a bunch of dots on there. And a normal curve would slope up and to the right. Start in the bottom left, slope up and to the right, meaning that as you went further and further out until bonds mature, their expiration date, right, the yield would get higher. And that seems a normal thing. You would expect to want to earn more money on holding a bond for 30 years than you would, let's say, for holding something that's 3 months to 6 months, 1 year. That's a normal curve. And what happens is when you see rates start to sort of compress, and by compress, I mean the difference between, let's say, what you could earn on a 3-month bond and what you can earn on a 10-year or a 30-year, when they sort of become very similar, we would say the curve gets less steep, meaning going from the bottom left to the upper right, that line is, instead of going, up and to the right and a little more vertical, the line gets a little more horizontal. And so it flattens and the line is more straight across. And that's really what we're seeing right now. And so to give you an example, I pulled some rates from, and we're here in July of 2018. If we plotted these across, A 3-month rate would be 1.95%, 6 months would be 2.14, 2 years 2.63, 5 years 2.82, and 30 years 3.09. And so when you start to kind of look at all these rates, they're relatively flat across the maturity spectrum, even the further you get out. And so that's what they're talking about, a flattening yield curve, when rates are more equal across all different maturities. Now, that's what a yield curve is. All it is it's a plot, it's a graph, it's a line graph, just illustrating what the different maturities are. And it's more steep when short-term rates are much lower than long-term rates. It's flat or flatter when short-term rates are more equal or closer to longer-term rates. And there's a normal, there's a flat curve, and there's also something that's called yield curve inversion. And when the yield curve inverts, what you actually see is the shorter end of the curve, or the shorter end, shorter maturities, your 3s, your 6, 1s, 2s, they might be higher. For example, let's say if you're looking at 10-year versus 2-year, you might see the 2-year yield be higher than the 10-year yield. And when shorter term rates are higher than longer term rates, and there's a couple of reasons why that happens, but that's called a yield curve inversion. We're not inverted yet. We're currently a little bit of a flat curve, but there has not been any yield curve inversion yet. And so one of the reasons why you're hearing about all this talk about yield curve inversions and the flattening of the yield curve is because we've got some historical perspective. And by the way, if I'd even mentioned this in the book Broken Pie Chart, every time you're looking at an investment or anything, it says past performance is no indication of future results. So just because something happened, and it happened with relative frequency, the last number of recessions, meaning the curve is inverted prior to the previous recessions, it doesn't necessarily mean it's going to happen in the future. But that's the reason why you're seeing all of the articles, all of the talk on the financial news networks about potential yield curve inversion. And the reason why they're doing that is each of the last bunch of recessions, the yield curve inverted at some point prior to the recession. And that's what they're talking about. Now, to give you a little perspective on this, 2008, 2009, the Great Recession of 2008, one of the worst and deepest recessions that we've seen, the yield curve actually inverted ever so slightly. And we're going to use the 10-year maturity on the U.S. Treasury and the 2-year. And this is when the 10-year went slightly lower than the 2-year yield. So we had some inversion there. That happened December of 2005. Now, to think about this, we didn't start to see the recession show up until, December of 2005. It's really more like January of 2008, right around there. That certainly the market started to go down. And when people, when economists go back and they sort of put a start to a recession, they backdated a little bit, but that's about when it started. So you're talking about roughly 2 years or so from when the yield curve inverted to when the recession started. When you go back and look at a number of these other ones, I think the range is somewhere, 12, 13, 15 months, 20 months prior. And again, I'm not saying that if we do invert, that necessarily means it's going to be a recession just because it's happened every time. But there is historically been some time between these. But they're going to be hitting you with stories right now because it's something that's happening. And, unfortunately, sometimes on news networks and getting clicks, putting a little fear out there is helpful to get page views. But there's some perspective there. Even when it's happened, it doesn't necessarily mean a recession's immediate. And interestingly enough, if we look at, the market probably went up roughly another 20% or so from when the yield curve first inverted and when the recession started, and then obviously in January of '08, when we first start to see price decline in the markets. And so the reason why people feel like the yield curve inversion shows economic weakness or has been a good predictor, well, it's a couple things. The first is that when people believe that, there's always this flight to quality. And so one of the reasons why they say long-term rates stay low, remember there's an inverse relationship between the price of a bond and interest rates. And it means when interest rates go up, typically bond prices go down, and the inverse, when interest rates go down, bond prices go up. And often in times when people are a little trepid about the economy or about the markets, or there's some sell-off that happens, often there's a flight to quality, meaning people buy bonds. And when people buy bonds, bond prices go up and the yields go down. And so that's one of the things that's pointed to is you'll hear people talk about, well, if people are not as confident in the longer term prospects of the economy, maybe they're less apt to hold short term, or they'll hold stocks. Maybe they'll rotate into bonds. But that's one of the reasons that you'll hear. The other thing that you'll sort of hear about a little bit. There's really a couple of things you're going to hear about. And let's talk about the idea about how banks make money and how the yield curve, an inverted yield curve, potentially might impact that. And so the old adage is that banks tend to borrow short and lend long. And let's say, when they lend, they might issue a mortgage. And so they're collecting interest on the mortgage, and they're paying interest on, let's say, deposits or things like that. It's a really oversimplified explanation, but if you think about it, if short-term rates rise and long-term rates are lower than short-term rates, banks that are borrowing short and lending long, they see what's called their net interest margin start to work against them, compress, or even go negative. So that's one of the things that you'll hear a little bit about is the idea of how this affects lending. Beyond the scope of this podcast, there's also swap trades. There's sort of carry trades where people are long or short one end of the curve, and that starts to break down a little bit. But that's one of the things that you'll hear. So definitely people talk about less confidence about the long-term outlook. They'll talk about how banks, net interest margins. The other thing that affects how interest rates happen, the short end of the curve is probably a little bit more dependent on what the Fed is doing. And so right now we're seeing the Federal Reserve has risen rates. Risen, is that the right way to say that? Rates have risen in the last, since staying at zero for basically a decade. And the short end of the curve is a little more susceptible to those interest rate, the Fed funds rate. That's what you hear about on TV. The long end, not as much. The long end, 10-year, 30-year, things like that, a little bit more dependent on inflation and the inflation outlook. And so inflation, although it's risen, and if you listen to the Fed talk, they say, look, it's finally above 2%, which may or may not be their target, or I guess, they've talked about it being their mandate or target. But interest rates, or actually inflation, certainly has an effect on that, and we haven't seen inflation really run away. And that's one of the things that people point to as well. And so you're starting to hear a few things, either in articles or on TV about, one, the interest rate we're seeing a flattening yield curve and how it's predated every recession going back to whatever year it is. And this may be pointing to, potential for some recession in the future. And we know recessions, depending upon how deep and how sharp, they could have negative impacts for the market. Certainly the last one we had started in '08, and I believe it ended sometime right '09 from memory. I have to look it up, but you're going to hear a couple things. One, it's a good predictor of future recessions. You're also going to hear, hopefully, people couch it a little bit by just because something inverts. And by the way, it hasn't inverted yet. We don't know if it's going to invert, but just because it inverts doesn't mean it's immediately imminent. We talked about the distance between when it first happened in December of '05, however slightly, to really that January '08 period, so roughly 2 years. You'll talk about how the other thing you'll hear about is, well, this time is different. Remember the quote, "This time is different," that things don't matter. And maybe they're right. Maybe they're wrong. But you'll hear some talk about, look, I mean, interest rates were so low for so long. This is a different paradigm. It's a new era. We've never had a Federal Reserve try and go from essentially a zero band or a 0% interest rate and inflate them or rise them back up and try and create a normal interest rate environment. It's never been done before. We had quantitative easing. We had Operation Twist. We still have things going on in Europe. But you'll hear talk about that. Maybe this is a different situation. You'll also hear about maybe banks are able to hedge their interest rate risk more. They're using swaps, or so it doesn't matter as much. You might hear some talk about that. One of the things that's very interesting, typically if you look at global interest rates, you'll see countries outside of the U.S. yielding more, meaning investors perceive that there is more risk to holding, France or Germany or UK or name the country, right? Germany and the U.S. right now are certainly considered some of the most safe haven areas to park money. But when we talked about the U.S. Interest rate curve or yield curve is fairly flat right now. If you look at Germany's curve is relatively normal. And although on the short end of their yield curve, if you want to look at German bonds, which are government bonds issued by the German government, the 2-year is a negative 0.62% yield. That's right. It's yielding negative. So in theory, if you buy the bond, you've got to pay interest, not earn interest. The 5-year is negative 0.26. The 10-year is a positive 0.39. And the 30-year is a positive 1.05. But one of the things that's recently been in the news is the difference between the yield on, let's say, the U.S. 10-year Treasury and the 10-year German Bund government bond is the highest difference in yield since like 1989, so quite a long time. And so I expect there to be some talk about how even an inversion in the U.S. doesn't matter, because if you look at Germany, theirs is still normal, but also the spread or the difference between our rates and their rates is so wide right now that you're just in this different paradigm, this different shift. Look, the bottom line is I want you to understand what they're talking about. What do they mean by yield curve inversion, flattening yield curve, normal yield curve? What are they talking about when they flash a chart on the screen? They'll call it the 10s minus 2 chart. All that is, folks, is just the yield on the 10-year Treasury minus the yield of the 2-year Treasury. And I'll put a link to a chart from the St. Louis Fed, Federal Reserve Bank of St. Louis, who has a chart, 10s minus 2s, easily accessible. It's free online. I will link to that in the show notes. But that's something that you're going to hear too. And you're going to see that the spread has been narrowing, and that is indicative of a flatter yield curve. But I also just wanted to talk about some of the things that you're going to be hearing. And it's everything for why it's a great predictor of past recessions and can indicate weakness. And the other is you're going to hear some talk around why it doesn't matter as much in this current time frame. The important thing, though, is that anytime that you're seeing some talk about fear in the markets, you're seeing talk about there's something that's out there that's worrying. You've got people making predictions about whether the market's going to go up or down. I always want to remind people this. It's really difficult to time markets. It's difficult to try and pick the bottom, pick the top, and figure out when to get in or out. And there's really two schools of thought. I mean, some people are invested right now and they're saying, well, I'm a little bit worried. I want to get out because all this yield curve inversion, you got these professionals on TV that are talking about it. But getting out now might mean foregoing profits and if the markets continue to go up. And, certainly I don't predict what markets are going to do. The other side of it is maybe, you've got money that's yet to be investing. You're saying, well, all this talk about the inverted yield curve, this is not good. I might want to hold off here. Really, the thing that's interesting is I like the idea of having protection on portfolios. And one of the things you can read about in the book, and I'll put a link to the book, is the idea of building, using strategies that build portfolios that have hedges in them. A hedge means to hedge the downside, buffers, things that sort of buffer the downside, but still capture, a good chunk of the upside of markets, or that's really the goal. And so, the key is though, if you have some sort of embedded protection in portfolios, and you're hearing talk, whether it's the yield curve or it's something else, hopefully that's one of the ways that you can kind of take a little bit of pressure and reduce the fear a little bit, and potentially stay invested or get invested, and have a little bit more, less anxiety about all the stuff that's going on in the market. So in times like these, I think it's a good opportunity to take a look and review and see, how is everything sort of correlated? I mean, how does everything act together? And then, if this is something and we're going to see a downturn in the markets, what type of protection do you have? And by the way, if it's not, how are you capturing sort of the upswings as well? So I'd encourage anyone listening to this to, if they want to schedule a quick phone call, reach out to me, and I'm happy to go over a couple things. But as we do these podcasts, the goal is really to help simplify a lot of these concepts that you're hearing. And when you get to, although the concept of a bond, and most people have had savings bonds, or maybe you've bought bonds before, you have a bond fund. Sometimes bonds, you hear all these terms about yield spreads and basis points and all these types of things. And it sort of gets a little complicated. And so let's uncomplicate it for you, but let's look and try and keep things in perspective, and try and help out with some of the fears. So with that, we're going to wrap up this week's episode of the Broken Pie Chart podcast. This was episode number 2. In the show notes, I will link to a couple things, as well as a link to my book, Broken Pie Chart. And until next time, we'll talk to you soon.